All callers are muted and they can unmute themselves.
Well, good afternoon. This is Travis Marks, Vice President of Investments and Client Relations, and I'm joined with Steve Tuttle, the Chief Investment Officer of the company. And we're going to present to you the second quarter 2012 investment review, and we're going to discuss the performance for the last quarter, our economic outlook, and how our outlook is affecting the way we're investing client portfolios. So Steve's going to start. I'm going to finish up with a couple of slides at the end, and then we will open up the call for questions at the end. So if you are logged on to the live meeting, there is a bar on the top that says Q&A. If you click on that, you type in your question and you hit ask question. We'll get a queue of questions at the end. We'll answer any questions that you have. So with that, turn the call over to Steve Tuttle, and he's going to present the presentation. Steve?
Good afternoon, everybody. As Travis said, my name is Steve Tuttle, and we are going to talk about a number of things today. We're going to start with a quick review of what took place most recently in the markets, and then discuss a little bit about our outlook, looking forward, valuations, where we see risks, and then cover how we are deciphering this information and how it applies to our client portfolios. So just to start with a quick overview, global debt is the main concern that seems to be affecting the marketplace right now. Most recently in the second quarter, Europe was really dominating the media, having to do with the debt that Europe faces and the lack of growth, and how they're going to get out from under the excessive debt burden that they're under right now. So that did drive down at least the riskier areas of the stock market. And obviously that's not the greatest for stock portfolios, but the bright side of that is with risk comes opportunity. So although we're not doing anything in Europe currently other than our normal allocations to foreign stocks, it's an area that we are looking for, because at some point, as I said, risk becomes opportunity, where values get driven down to such a point that it could lead to high expected returns in the future. So it's something that we are closely watching. On the bond market in the second quarter, risk-averse assets did fairly well, and that plays into our strategy of owning quite a few bonds. Treasuries are the area of the market that we don't have a lot of exposure to. We're more focused on higher yielding areas of the marketplace on the bond side. Overall, our conservative bias continues, and we'll talk about that in a few minutes. So this chart shows the various asset classes and how they did recently in the second quarter and also year to date. And without going into either any of the asset classes in great detail, what you'll see is bond assets were up in the second quarter. Stock assets and other riskier assets were largely down in the second quarter. Year to date, however, stocks are outperforming bonds. This slide is a chart that covers correlation of U.S. large cap stocks, and essentially what it reveals. Well, first of all, before I tell you why I'm showing this, I just want to define what correlation is. Correlation, in simple terms, is the extent to which stocks move together. So whether stocks move up or stocks move down, correlation measures the extent to which all stocks tend to move in sync. So when correlation is high, on average, on good days, all stocks are going up, and on bad days, all stocks are going down. Lower correlation would mean whether a stock goes up or down is more affected by the individual circumstances of that company. And what this slide shows is that, particularly since 2008, so the financial crisis that we experienced in 2008, since that period of time, correlations have gone up to all-time highs. And the major implication of that is that it makes it harder for stock pickers in this environment. All right, so those who make their living finding the best stocks in the marketplace are having a difficult time. And those and again, it has to do with correlation. So when people are averse to risk, they're selling all their stocks, whether they be higher quality, lower quality, they're selling everything together. The other implication is that it makes it harder to diversify. Traditionally, you don't want to own just a few assets or a few stocks. You want to own many stocks. And the rationale behind that is that, well, if a certain area of the stock market is performing poorly, there should be other areas of the market that are performing better. And while that still holds up, I believe, in terms of how it's playing out in the stock market recently, last 5 years, is that, as this chart shows, everything seems to be moving in sync. So it's a challenge that investors face today. All right, getting back to Europe a little bit, I'll discuss a little bit about how we view Europe. And essentially, the big problem that we see in Europe is that they have to come to grips with the fact that there's a lot of debt in Europe, and the big challenge to the European countries is that there's a lack of unity. And by that I mean each country is acting somewhat independent and have their own motivations and their own circumstances to deal with. And because they are allowed to act independently, it's difficult to reconcile the problems of one particular country or another. I mean, specifically Spain, Italy, Greece, these are the names that most investors are most concerned with. The problem is their situation has implications for the rest of Europe, and any solutions that have to take place have to be agreed upon by all countries over there. And Germany is the strongest country in the Euro land, and it has to some extent make some concessions, and it has made some concessions to help the good of the overall Euro. But again, the big concern is that this could take many years to work out, and the real risk that we see is it would be a breakup of the Euro, and that's something that is a real risk. I don't think it's the most likely outcome at this point in time, but it's something that we're concerned with because I think that would have negative implications for the rest of the global economy. Over here in the U.S., our economy has been doing much better than the rest of the developed economies. But what's increasingly getting attention from the media and from our analysis, if you've read our commentaries with your reports the last few quarters, is this notion of the fiscal cliff. And essentially, the challenge is that the way our tax policy is set up right now, beginning in 2011, if nothing changes, if Congress doesn't act, we will see taxes rising and spending cuts, automatic spending cuts enacted. And the net of this should be a slow a drag on the U.S. economy, which would be negative for stocks. Most of me thinks that this will get resolved and that Congress will do the right thing. But even if that is to occur, it's doubtful that anything is going to occur before the election. And even if it were to occur, it's probably not going to occur until the last minute, until Congress has to act, has to come up with a compromise. And in the meantime, there could be instances where investors fear the worst and rush to safe investments out of risky investments. So how are we positioning portfolios today? And for those of you who have been clients for quite some time, these themes should be nothing new to you. Essentially, we are structuring portfolios to have slightly below average risk compared to more normal environments. Within that, however, within our risky stock exposure, we are focused on certain areas that we think offer more opportunity. So we're trying to skew our portfolios towards areas that have a more attractive risk relative to the reward that they potentially could provide. And that leads us into areas of higher quality stocks and dividend paying stocks, and less exposure to more volatile, speculative growth type names. On the fixed income side, we're focused on avoiding interest rate risk and generating higher income. And that leads us to, at least in the individual bonds that we are buying, bonds that are, in terms of credit quality, a few notches below treasuries, but still investment grade. So BBB plus to A-rated individual bonds are generally where we're finding the most value in the marketplace right now. And we're staying fairly short-term, keeping bond ladders to 6 years or less. Occasionally, if there's a good opportunity, John could extend that to 7 years. But for the most part, we're trying to stay short, and we're also trying to get a decent amount of income to provide for stabilizing client portfolios. The other area that we are using in portfolios has to do with alternative investments. And essentially for alternative investments, we're talking about non-traditional sources of return. And basically why we are using these types of securities right now is because we believe they provide more return potential than bonds, but lower risk than stocks. And so that's a nice combination of risk to reward that we're looking for. And so in client portfolios, we're using arbitrage funds. We're using structured notes, which have some downside protection, but also exposure to stock markets. And for income clients who really are trying to maximize the income, there are also option strategies that we're using to generate option premiums. There's also master limited partnerships, real estate investments, and other securities that, again, are a little bit non-traditional, but we think in this marketplace makes some sense. And then overriding all of our decisions is the fact that we're looking for opportunities. We're looking for markets to misprice certain asset classes where we can reshift some capital from safer investments into investments that generate higher returns. An example of that most recently is emerging markets debt. But as we mentioned, there's other areas that we're focused on. European stocks are a possibility down the road. Emerging market stocks, again, something that we're interested in. We have some exposure in the portfolios, but at the right price, we would be happy to increase our exposure to those areas. High yield bonds are another area that we focus a lot of our research on. And depending on pricing, that's an area where we could get more aggressive in that space, again, if the price is right. So this chart shows graphically the struggle that we're having with providing income for clients. And traditionally, an investor could invest in treasuries, CDs, savings accounts, and still generate decent yield to provide for income in retirement. But this chart shows how far Treasury yields have dropped. And this is a chart of the 10-year Treasury yield yield, and it basically shows for the last 30 years, yields have steadily dropped, and now the 10-year Treasury is down around 1.5%, which is I don't think it's been down at this level since the 1940s. So it's a struggle today to provide income. So what are we doing for clients that need to generate income? Well, again, as that chart shows, bond prices are fairly high and interest rates have been driven to basement levels. So that forces investors to expand beyond those traditional sources of income. And the problem with that is you can get into areas of the marketplace that have some risk and have some complexity. And that again is an area where we are focusing a lot of our research capability towards understanding and uncovering opportunities to generate income without exposing portfolios to unnecessary risk. And the areas that we are currently focused on for that happen to include emerging markets bonds, master limited partnerships, floating rate and bank loan funds, high yield bond funds, both corporates and munis, dividend paying stocks, real estate investment trusts, and option strategies. And you may see some, if not all of these securities in your portfolio. If you have any questions or interest in learning more about any of these particular areas, we'd be happy to discuss it with you individually. So this chart is interesting. What it is, and it's a little confusing, so I'll try to explain it as best I can. Essentially, on the bottom it's measuring average duration in years, and essentially this relates to how exposed is a particular bond fund, how exposed is it to interest rate risk. The higher the duration, the more sensitive that fund would be to changes in interest rates. And on the left is the SEC yield, and the SEC yield is essentially if you were to buy the fund or you own the fund today, what is it paying currently? What did it pay in the last 30 days? And what you'll see is, and this is related to the fact that interest rates have dropped so far, on the bottom right of this graph, of this grid, is the least attractive part of the bond market right now, or in our opinion, and that's represented here by the Vanguard Total Return Bond Index. So you see it has a duration over 5, and it yields less than 2%. So it has a fair amount of interest rate risk, and it doesn't throw off a lot of yield. So to us, we're trying to either generate more yield or ideally generate more yield with lower interest rate risk. And the other dots, all above or to the left, above and to the left of the Vanguard Total Bond Market Index, these are represented by some of the funds that we use in our client portfolios, and you'll see in almost every case in this example, they offer a better combination of yield to interest rate risk. So here is a rundown of the major asset classes that we track and how we are currently positioned in client portfolios. So in fixed income, traditional bonds, investment grade bonds, we're at a normal weighting. Within that normal weighting, however, we don't own a lot of treasuries. We are favoring corporate muni bonds that pay higher interest. We are using absolute return oriented mutual funds, and the reason we're using these is they have very flexible mandates that allow them to quickly adjust the portfolio to changing to the changing environment. And as that last slide showed, many of these funds are currently generating attractive yield without exposing themselves to a lot of interest rate risk, and that's the combination that we're looking for. High yield bonds, corporate muni and floating rate bank loan funds. We are overweight, and these are focused mainly on clients that have a preference for income. So if you have a traditional balanced account, you may not see these because we're able to generate return from other sources, traditional stocks. But if you are focused on the bond market and don't want to own stocks, this is where we're adding a little bit of risk and return or higher yield to the portfolios. And then also within the fixed income space, we're overweight emerging markets debt. On the stock side, and this gets into our conservative bias right now, we're basically underweight stocks in general. So we're underweight the U.S. market, we're underweight the foreign market. Within our equity exposure, as I mentioned before, we're emphasizing dividends and higher quality. And then alternative investments, alternative strategies. I went over these a few slides ago. We're overweight those areas in normal levels. Arbitrage funds are our main security that we're using, as well as structured notes, and in certain instances, other income-producing assets and option strategies. So I want to talk a little bit about some concepts that many investors might not be familiar with, but it's important to review because it is a key part of our strategy. And the titles, the slide is titled Key Sources of Alpha. And before I go into that, alpha is essentially alpha is outperformance from the stock market or the bond market. So how do you generate return that's in excess of what the market is providing? And there's many different ways that you can potentially generate return or alpha. And the most publicized and perhaps most popular source of alpha that the media focuses on is expected returns. That's all the way on the bottom of this chart. And while we do also focus on expected returns, we also focus on other areas that we can add alpha, and we can probably add alpha more reliably than expected returns. I mean, the trouble is expected returns are the most unpredictable aspect of portfolio management. So we focus, in addition to identifying areas that we think can generate nice returns, we make sure that we focus our attention on other areas such as portfolio construction, risk management, and cost control. And to give some examples of what we mean in each of these categories, we've laid out a few things, a few specific things that we do in all of our client portfolios in an attempt to generate alpha. All right, so in terms of portfolio construction, you want to have a portfolio that has access to multiple sources of return. All right, we don't want to structure our portfolios so that the only way we can make money is if the S&P 500 goes up. All right, we want to make sure that we have the opportunity to generate return from the bond market, from all different areas of the bond market, from all different areas of the stock market, from value strategies, from growth strategies, from options volatility, from dividends, from interest. So it's very important that that we have exposure, that we cast a wide net and we have exposure to these different sources of return. All right, we want to allocate risk, similar concept. All right, we don't want to have most of our portfolio exposed to the same type of risk. It's better to diversify, to have different parts of the portfolio that react differently to a various stimulus that the market might provide. And then low correlations are also a benefit of portfolio construction. As I mentioned in the beginning of this presentation, that's a challenge today, but again, it's something that we are always focused on, and we do our best to provide low correlated assets in a portfolio. All right, in terms of risk management, we don't want to limit our risk concentrations. We don't want to own an excessive amount of one particular sector of the marketplace. In our opinion, that's unnecessary risk. We don't need it to generate attractive returns. We want to target appropriate volatility levels. This goes into who our client is. All right? What is appropriate given their goals? It's very important that we keep that in sync with, keep our portfolios in sync with what our clients need. Use tactical adjustments to control drawdowns. That goes into not only being aware of the valuations in the marketplace, but also knowing and understanding where the risks are. And presently, we've identified some risks and we've adjusted the portfolios accordingly. Costs. Costs are an area that is important. I mean, particularly in an environment where stocks and bonds are, on average, not returning as much as they have historically. It's important not to use excessive trading, which could drive up costs, or to be exposed to high fee, high load with sales charges, commissions, etc. Securities. So we take a very cost-aware approach. It doesn't mean we're always going to choose the lowest cost investment out there. What it does mean is that we very seriously consider the cost when we decide to make changes in the portfolio. And cost also includes taxes. All right, we want to manage taxes. No reason to pay the government any more than we have to. So we continually look for opportunities to harvest losses when we can, which would offset future gains, and also to use asset location. And by that we mean if you own a IRA account, which is tax deferred, and you own a taxable account, we are going to put the least tax efficient securities, such as corporate bond funds, high yield bond funds, in the IRA, and we put more tax efficient vehicles like stock ETFs and index funds, municipal bonds in the taxable account. So if you own those securities, you might see allocations that are quite different from your IRA account to the taxable account, but that's done with a specific purpose, and the purpose is to generate attractive after-tax returns overall. And then lastly, and I say lastly because, again, this is the most unpredictable part of the investment management process, at least in the short term, and that's to focus on expected returns and identify investments with superior return potential. That's not something that we ignore here, but we are very cognizant of the fact that this is, especially if your focus is too short-term oriented, this is difficult to achieve consistently. So we want to identify securities that we think generate higher return with less risk. That's the goal, all right? But we need to be patient. We need to have discipline when trying to achieve that. So with that, I'll turn it over to Travis. I thank you all for listening.
Thanks, Steve. So I just have one chart here, and then if anyone has a question, again, just press the Q&A button on the top and ask your question and hit ask question. So what this chart here shows is something we think is very interesting. It looks at the average return from the stock market and the average return from a bond market, and it also looks at the average return that an investor got in those areas. So, for example, the stock market in 2011, the stock market was up 2.1%, and the average stock investor was down 5.7%. And that's proof right there that the average investor is doing something a lot different than the market on a whole. And also, if you look at the average bond, if you look at the average bond investor only did 1.3%, and the average allocation did negative 1.3%. But the point here is that the S&P 500 did 2.1, and the bond market did much higher last year. And the reason why the average investor, the retail investor, is underperforming is for a few reasons. One of the reasons is what Steve was talking about with fees and taxes. You know, it's like when you go into a taxi cab, every time you go into the cab, you have to pay a fee. Every time you are trading your account, you're paying a fee and you're reducing your return. With taxes, if you are churning your account and you're looking for the next hot opportunity, which is what a lot of retail investors do, they are paying short-term capital gains, which are taxed at their tax rate, which could be 30, 35%, whatever it is. If you wait if you're a longer-term, more patient investor, you only pay 15% capital gains. So that's a huge difference. So you can imagine getting 10% return and paying, 3.5 points on that if you're doing short-term, or if you're long-term, you only pay 1.5%. I mean, it's a big difference, and then when you compound that over a long period of time, it makes a huge difference. So why are we pointing this out? Well, the point of it is to, one, if you have money outside that we're not managing, it's a fair warning. Try not to do it. Again, easier said than done, but studies have shown that you should try not to do this. Also, let me mention real quick that actually the biggest reason why the average investor underperforms is because of fear and greed. They're looking on TV, they're looking at Forbes magazine, they're looking at some news source, and they're seeing a hot idea. Well, by the time it gets to them and by the time it's a hot idea, most of the gain has already been taken out of the equation. So they're buying at the top of the market. And that's what the studies show. Also, on the other side, when they're the most fearful, when everyone and all the papers are saying sell and there's, hysteria on CNBC, that's when they're selling rather than looking for opportunity. So that with fees and expenses are the reason that average investor underperforms. So try not to do that. And of course, we're also trying to point out the value we provide because, for one, we take a longer-term view. So we're not churning the account. We try to manage portfolio very efficiently for taxes. The other thing is when the markets are selling off, we're looking for opportunities. We're looking for tactical bets. For example, in 2008, when high-yield bonds were selling off, they were trading at historic lows, but no one wanted anything to do with them. We were buying them in 2008, early 2009, and they were one of the best performing asset classes for a few years. So that's some of the value we bring to the table. Likewise, when things are rallying, we're looking to take profits before the market starts to sell off. So if you can avoid doing what the average investor does or trusting an advisor that takes the emotion out of the equation, you're better off. So with that, if there's any questions, just click on the top button here. And there is one question here. Let's see what it is. Oh. Just bear with me here. Oh, technical issue there. Someone was using a different computer. So if there are any other questions, again, just ask right now. If not, thanks again for your time today. We appreciate your business. We appreciate your continued trust. If there's anything we can do, if there's any other questions that come up after the fact, give me a call, give us a call in the office, and we'll be happy to help you. Again, thank you, and we will speak to you soon, and certainly join us next quarter for the quarterly review. Have a great day.